VU is the Vanguard ETF that tracks the S&P 500. If you had bought that at the very start of the year, you would have bought it for $631 per share. It's currently at $635 per share. So what we did on this spreadsheet is we looked at a hypothetical investment of $100,000 into VU. You would have bought 158.5 shares of VU, and currently that would be worth $100,672. That would be a $672 profit, and you'd be up 0.7% on the year. So these 8 companies are Amazon, Meta, MU, which is Micron Technologies, NVDA, CDE, which is core mining, that's a gold mining company, Johnson & Johnson, AOS, that's A.O. Smith, that's a water softener, water heater company, and EXEL, the biopharmaceutical company. So we picked these 8 stocks to have a fantastic 2026. And now that January is gone and we're 1 week into February, we're going to check on how these companies have done. Now, I have price predictions for all 8 companies right here. This is what we think that they were worth at the start of the year based on intrinsic value calculations. If you want to see how to compute intrinsic values of companies, which is an absolute must for any investor, link to those videos in the description of this video. Now, what we're going to do is we're going to look at 3 different scenarios. What if we bought these 8 companies equal weight? So we put the same amount of money into each of these 8 companies at the start of 2026. Well, that would have put $12,500 into Amazon, and that would have purchased 54.113 shares of Amazon. And currently that would be worth about $11,000. So Amazon has seen some pain. That's a 9% drop in Amazon, so that's not looking too good for our predictions. Next up would be Meta. Also, we would put $12,500 into Meta in this equal weight scheme, and Meta would be down about 0.2%. So we've lost about $29 in our investment in Meta, hypothetically speaking. But MU, Micron Technologies, that makes up and then some. If we put $12,500 into Micron, we would have purchased about 43 shares of that company. That would have been a $4,600 profit so far this year alone, just 5 weeks into the year. That's a 37% gain on MU. NVIDIA, also some pain in NVIDIA recently. There's a negative 1.4% loss in that company. If we had put $12,500 into that company, we would have purchased 66 shares, and those would now be worth under $12,300, or about $12,300. Now, another big gainer would be core mining. $12,500 into that company would have purchased about 694 shares, and those would be now worth almost $15,000. That's almost a $2,400 profit, 19.1% growth just in the first 5 weeks of the year. Johnson & Johnson would come up next. $12,500 would turn into $14,500. That's a 15.9% gain in Johnson & Johnson. A.O. Smith, another double-digit winner, 18% gain. $12,500 would have purchased 186 shares. That would now be worth $14,735. And EXEL, we're about flat on that. We would have lost $28. We would have purchased 284 shares. So that is equal weight overall. And had we done that, we would be up about 9.9% on these 8 companies. So far outpacing the S&P 500's 0.7% gain in the same time frame. Now we ask the question, what if we purchased $100,000 worth of these companies, but based on market cap, which is more in line with how the S&P 500 kind of does things anyway? And so Amazon also down 9%, but we would have put $25,770, and that would now be worth $23,463. So quite a significant loss in Amazon. Meta, we would have basically broken even. We would have purchased, instead of 18.8 shares, we would have purchased 26.2 shares, and those would also be down. Now, MU, because their market cap is so small, we're not purchasing $12,500 in that company. Instead, we're purchasing $3,370 worth. So instead of the 43.4 shares that we would have purchased with equal weight, we would have only purchased 11.7 shares of this company. And that still gives us a 37% profit, but just on those shares. And unfortunately, in the market cap investment scheme, that doesn't pan out too well because it's such a low market cap. NVIDIA is the big dog. NVIDIA is, I believe, the largest cap company of all these companies. And so we would have purchased almost 48% of that $100,000 in NVIDIA. And because it's down 1.4%, we would have lost quite a bit. We would have lost $659 as opposed to $172 because we purchased so much of NVIDIA. CDE Core Mining, another fantastic company. They've gone up 19.1% this year, but their market cap is teeny tiny. It's just 0.1%. So we would have only purchased $122 worth. That's about 6.78 shares of CDE. Compare that to the 694 shares we purchased with equal weight investing. So this market cap investing is not looking too good because these smaller cap companies are the ones that are really keeping things afloat. Johnson & Johnson, we would have purchased 5.2% of our money, 5.2% of our $100,000 into Johnson & Johnson. Also up 15.9%. But if we look, we would have only purchased $5,200 of that as opposed to $12,500. And so we would have only made $829 of off Johnson & Johnson as opposed to almost $2,000. AOS is another teeny tiny market cap. We would have only purchased $98 worth of this company. That's about 1.5 shares in the market cap investment scheme. So instead of $12,500, we would have purchased only $98. So that 17.9% gain in this company would only be $17.48. Compare that to the $2,235 we would have made in the equal weight scheme. So you can really see it's not just what companies you purchase, it's how much of those companies you purchase as well. Okay, that's also very, very important. So it's looking like this market cap based way of investing, which kind of mimics and parallels the S&P 500. Probably so far is not the way to go. And finally, EXEL, another teeny tiny market cap, 0.1%. We would have invested $123. We would have lost 28 cents. So basically broken even on that one as opposed to losing $28 in the equal weight scheme. So when all is said and done, we're actually underperformed the market if we invested based on market cap. Okay, market is up 0.7%. We would have been down 0.9%. That's about a 1.5% difference. So not too terribly good on that front. But finally, what if we use the inner flame finance weighting? So in that video, linked in the description below, we actually based our weighting and how much of this $100,000 we would purchase based off of the score that we came up with our inner flame finance methodology, as well as the margin of safety and the intrinsic value of these companies. So how would this pan out in this scenario? Well, Amazon, we would have purchased about $5,000, 5% of our allocation goes to Amazon. That would have purchased 21.65 shares of Amazon, and we would be down, unfortunately, $447. So far, not looking too good. Meta, we would have purchased $3,000. That would have purchased about 4.5 shares of Meta. We'd be down only $7 in that. In the equal weight scheme, we would have purchased $12,500, but we were particularly bullish on MU. So we would have purchased $14,000 worth of MU. 14% of our money would have gone to that. We would have purchased about 49 shares based on that weighting. And so we would be up $5,186 as opposed to the $4,630 with the equal weight investing. So that panned out quite nicely. NVIDIA, we were also very bullish on in that video. And so we would have purchased 16% or $16,000. And that would have purchased about 85 shares of NVIDIA. And because NVIDIA is down, we'd be actually down more, $220 as opposed to the $172 in the equal weight investment scheme. Core mining, we had some pretty good feelings about. 10% of our money would have gone to that, $10,000. That would have been a 556 shares of that company, and we would be up $1,111 in core mining. Johnson & Johnson, $16,000. So we had the same conviction in Johnson & Johnson that we did as NVIDIA. 16% or $16,000 going into that company. We would have purchased about 77 shares of Johnson & Johnson, and we'd be up about 16%. And because we invested $16,000, we'd be up $2,550 roughly, as opposed to almost $2,000 with the equal weight investment scheme. AOS, this was one of the more bullish ones. We felt that 17% of our capital should go into AOS. That would be 254 shares of AOS, and we'd be up $3,000 as opposed to the $2,200 with equal weight. And finally, we have EXEL, and this was our most bullish position for the year. We felt that 19% of our capital should go into that, so that's $19,000. That would have purchased 431 shares of this company, and they're basically flat, so we would have only lost $43, but with equal weighting, we would be down $28. So how does this pan out? Well, what's interesting to note is if we use the inner flame finance weighting that we had in that video, we would be up 12%. So compare that to the down almost 1% using the market cap, and being up 10% using equal weighting, and compare that to being up only 0.7% had we just put our money passively into the S&P 500. So there you have it, folks. That is the hypothetical $100,000 invested into the hand-selected 8 companies from the Interflame Finance portfolio. This is not financial advice. We are not telling you to buy, hold, or sell anything in your portfolio. Always do your own research and your own due diligence, and always buy companies that make sense for your personal portfolio. For the Interflame Finance portfolio, we would be up 12% had we invested $100,000 into these 8 companies using this weighting scheme that we came up with at the very start of the year. If you got anything out of this video, please like it. Feel free to subscribe to the channel so you can keep coming back for more updates for this hypothetical $100,000 invested, and also the other updates that we make, analyses on various companies and stocks, looking at the whole entire stock market in general, looking at specific sectors and companies. We go through it all. We use the Interflame Finance methodology for scoring, ranking, and evaluating companies, coming up with intrinsic values, and trying to find the best places in the market to put our hard-earned money. So I appreciate you watching. Thanks for stopping by and checking out this video, and we'll see you on the next one.